So let's look at the second scenario here. So it says that Crinkle Co. bought an asset for £10,000 at the beginning of 20X6. It had a useful life of 5 years. On 1st January 20X8, the asset was revalued to £12,000. The expected useful life has remained unchanged. That is, 3 years remain. So the requirement is to account for it as at the year ended 31st December 20X8. So that's our year ended, okay? 20X8. So let's see what we're going to do with Crinkle. So when it comes to Crinkle Co., we're going to look at the carrying amount of the asset. So this question is about subsequent measurement, right? We are in pound. So, let's put respect to the currency. So initial cost, £10,000. Now, they said that it had a useful life of 5 years, but then on 1st January 20X8, the asset was revalued. What does that mean? It means that from 1st January 20X6 to 31st December 20X7, we have to calculate the accumulated depreciation, and that is 2 years, right? That's 2 years. So we're going to calculate accumulated depreciation as at 31st December 20X7. So it's a straight line method. We know that because they have given us the economic useful life of the asset. We are not told of scrap value, so it means there is no info about scrap value. So we go in there and then get our figures coming up. £10,000 over 5 years times 2 years, how long it has been used. So if we do the maths, that is going to be an amount of 4,000. So we less that, so that we get a carrying amount at the beginning of the year. Carrying amount at 1st June 20X8, that becomes the opening balance. Now, so the question we then ask ourselves is, it was that date that they revalued the asset to 12,000. So if they revalue the asset to 12,000, what do? We bring in the revalued amount at 1st June 20X7, 12,000. And so the balancing figure will become a revaluation surplus. Now, this is the first time they are revaluing the assets, right? So this revaluation surplus will ultimately end up in where? The OCI and then revaluation reserve on the face of the statement of financial position, and that is 6,000. Now, we have to calculate depreciation for the year ended 31st December 20X7. Oh, sorry. I think we need to do 20X8 here, 20X8. So we need to calculate the depreciation for the year ended 31st December 20X8. So we less the depreciation for the year ended. Now, what did we say about revaluation of assets? We said when assets are revalued, depreciation will be charged on the revalue amount. So now from the 1st January 20X8, we're going to calculate depreciation using the revalued amount 12,000. And so that is going to be 12,000 divided by the remaining economic useful life. In the question, we are told that it hasn't changed since the life is 5 years and we have so far depreciated for 2 years. We are left with what? 3 years. Sometimes, this is an illustrative question. Sometimes the examiner would tell you the remaining life. Other times, you have to be the one to know that the remaining useful life is this amount, so you know how to calculate your depreciation. So over 3 years, and that's going to be what? 4,000. And so we get a carrying amount at the end of the year, 31st 12, 20X8. That's going to be $8,000. So if we should extract financial statement in the books of Crinkle Co., we'll bring in the statement of profit or loss and OCI, other comprehensive income. So in the profit or loss, what do? We have to bring in the depreciation for the year, which is an amount of 4,000 for the current year, 31st December. The depreciation we had charged in the last 2 years, those would have been accounted for in their respective years. So when we are preparing the financial statement for a specific year, we only bring the depreciation for that year. You have to be mindful of that. Don't add all the depreciation from the time we bought the asset and come and record it in the P&L accounts. No, in the P&L, it is only the depreciation in relation to that the year ended under review that will be recorded in the P&L account. Then we go to the other comprehensive income. And in the other comprehensive income, What we are going to be having there is the revaluation surplus or the revaluation gain, and that gave us an amount of 6,000. Now stay with me carefully. You realize that depreciation had been charged on the revalued amount, which means more depreciation, because in the previous discussions we were charging depreciation for every year 2,000. That's why the 2 years gave us 4,000 here. But now we are charging a depreciation for just 1 year 4,000. So it means we are charging more depreciation than we are supposed to have charged. So this is where we mentioned that shareholders could be compensated for the excess depreciation. Now, it is silent in the context of this question, but I'm going to show you how it will be done if we are supposed to do it. If the question is quiet, leave it and extract your statement of financial position and go away. But if the question requires that the entity makes transfer or you should make transfer, then it has to be done. So let me show you if we are supposed to make the transfer from the revaluation surplus to the retained earnings. And there are two ways we could do that. Okay, so let me show you option one. What you are comfortable with, you stay with it. The option one is just to say that the annual transfer will be equal to the revaluation surplus divided by the remaining economic useful life of the asset. So that is going to be our revaluation surplus, which is 6,000, divided by remaining economic useful life, which was 3 years. So it means the annual transfer is going to be 2,000. And what is the journal entry on that? You know that already. We said we will debit the revaluation surplus, which is 2,000, and then credit retained earnings, so that we reversed the effect of the excess depreciation causing the reduction in the profit for the year. Now remember, this occurs in the statement of changes in equity, not in P&L. So this movement is within statement of changes in equity and not P&L. Option number two. So you choose one. I know some of you will say, hey, sure, I like this one. Option number two is to look at the difference between the depreciation that we calculated. So depreciation on the revalued amount. The depreciation on the revalued amount was 4,000, and then depreciation on the carrying value. If we were charging depreciation on the carrying value, it would have been 6,000 divided by 3 years, and that would have given us 2,000. So the excess depreciation is what we transfer, and that is 2,000. So that is the second option. You choose one and you will be good. Choose what you are comfortable with and you'll be good. So this is our statement of profit or loss and OCI. Let's look at the extract of the statement of financial position for that same year ended. Gonna have non-current assets. What did Crinkle buy? They just said bought an asset. Okay, so we can just say property. Don't write PPE, okay? We just say property. Then we bring in the carrying amount at the end of the year, which is 8,000. Then under equity, we're going to bring in the retained earnings. Remember, it's an extract. So the transfer we made into the retained earnings, 2,000, will come. Then the revaluation surplus, we had made a transfer of 2,000 to the retained earnings. So we'll be left with how much? 4,000. This is the extract of the financial statement, and that is how we deal with revaluation of assets with subsequent depreciation and the treatment of annual transfer. Very sweet, simple, straight to the point.